get caught up with where we're at. All right. So today's Q&A is over improving credit scores for clients with low credit. Once per month, we host a loan officer Q&A. We put a survey out on Facebook just to check to see what topics you are wanting to hear about. So this month, it was dealing with low credit scores. One of the things we've been seeing is more clients looking to buy that have the lower credit scores. A lot of clients that have purchased already, who have the low interest rates at the 2s, the 3s, and the 4s, they're staying put. So we're seeing a different type of client come into the market right now. Okay, so let's go ahead and get started. So this is supposed to be a Q&A, so don't forget to ask questions. This is my subtle and obvious reminder that don't be shy. And if you don't want to talk, that's completely fine. Use the chat. The whole point of this is to make sure you're walking away with information that is helpful and applicable to what you're doing every day. So this is my encouragement not to be shy at all. So, and I'm going to change my view here. Okay. So my name is Ivory. I own a company called Insight Strategies. We are based in Washington State. We work with English and Spanish speaking clients on the credit side of things. So we're experts in the credit education and then the credit restoration processes. My background's about 15 years working in lending, regulatory compliance, default, financial planning. So a lot of areas that touch on finance and credit. I'm not going to spend too much time on that today, but this is essentially why I'm here today. Being in all these different areas of finance, what I noticed was there's not a heavy focus on teaching about credit. And in the lending space, it's one of the primary components that helps you to approve or deny a borrower. So it can be incredibly helpful to have a stronger understanding of credit and how it functions to help you close more loans. So for those of us that are here today, feel free to use, if you wouldn't mind using the chat, where do you think your knowledge base is with understanding credit or credit reporting today? So if you have a strong understanding, throw a 1 in chat. I somewhat understand credit, a 2. I'm novice but eager to learn, put a 3 in the chat. That's going to help me tailor how much I elaborate on certain topics just based on where the knowledge base for everyone is. Okay, so we've got some 2s. We've got 1, 1, and a 3. So what I'll do is I'll elaborate a little bit more on some of the topics today. And if you need more or something doesn't make sense, chat or just unmute yourself and just ask away. Feel free to interrupt me. I don't mind at all. And then what do you hope to take away from today's webinar and Q&A? Is there a burning question you have that you want to make sure we cover? If so, throw it in the chat or feel free to just speak it now. I want to make sure, even if it's not in today's prepared remarks, that I cover that topic. So feel free to throw that in the chat or interrupt me now. Okay, everyone just came with open minds. That works for me. Okay. So how many of you knew there were this many credit score algorithms? The FICO credit score is not so simple. So what I'm showing you here is the main credit scores that are used in lending today. Now, I'm going to turn on my laser pointer. This is what you're focusing on in the mortgage industry right here. FICO 2, 5, and 4. So when you're working with your clients, it's important that you educate them on why the credit score you're viewing is different than the one they're seeing on Credit Karma or even the Experian website. So Credit Karma is a Vantage credit score. It's not even this FICO model. It's a completely different algorithm other than any of these models you see here. If your client is looking at their FICO credit score on Experian, what they're going to see is right here, the FICO 8 score. This algorithm functions different than the one you're pulling, the FICO 2 score. And it leads to a lot of confusion because it is a FICO credit score. And most of us don't even realize there's so many versions. So now you may notice that this is FICO 2, 5, and 4. Back when this credit score was created in 1989, the bureaus were allowed to use different numbers. So it's the same algorithm, just different numbers. Now there's required to be uniformity across the FICO scores. So that's going to be the only difference. You're seeing a different number here. Or the only reason, excuse me, you're seeing a different number here. So just a touch point. Does anybody want me to expand on this further? No? Okay. The reason why I wanted to bring this up is because the advice I'm going to give to you today is very much hyper focused on the mortgage lending FICO, because that's the industry you're in, is the mortgage industry. So all of the advice, because it is geared towards FICO 2, 5, and 4, it may not be applicable in the exact same way for these other FICO models. So, okay. If no questions, I'll go ahead and move on. I got to figure out where I want to put everyone's faces here. Too many things on my window. Okay. So let's start with some quick hit tips. What you see on the screen is the FICO algorithm. So these components make up the credit score. We've got payment history at 35%, amounts owed, which is really just credit utilization at 30%, new credit at 10%, length of credit history at 15%, and credit mix at 10%. To clarify, all of these versions of FICO score have the same weighting. It's just the way this information within each category is interpreted is different on each of those models. So for example, with FICO, the FICO used in mortgage lending, a late payment is not necessarily time weighted, where with a FICO 8 score, once that late payment becomes 2 years old or greater, it's less impactful for the score. You're not going to see the same behavior with the mortgage FICO. Your late pay from 2017 is going to affect your score just like it happened last month. Okay. So, okay. So let's talk about some quick tips. So make sure there is an open and active credit card that has been used at least once in the last 6 months. Accounts must be active within the last 6 months to affect the credit score algorithm. So that's why I'm saying it needs to be used within the last 6 months. So you may see many credit cards on your client's credit report, but if they have not used these cards in over 6 months, they may not be contributing to that credit score as effectively as they could be. So making a simple transaction could cause your client's credit score to increase. Very easy, quick hit. If they don't have a credit card at all, not having credit means they're missing out on the section right here, amounts owed, the utilization ratio. So they're essentially just not affecting this entire portion of the credit score algorithm. So simply opening a credit card, you're going to see a jump in the credit scores. We had a question about what is the ideal utilization rate for clients to raise their credit score. Optimal utilization is going to be between 1% and 9%. If you are using Wayfinder or the simulator tool, it's automatically going to put your client in that zone, that 1% to 9%. So your Wayfinder, your simulator, your what if scenario tool, that's going to be your friend if you're trying to hit the optimal utilization when you're looking at your client's reports. Okay. Next section, don't pay off loans prior or during the application process. The reason for this is it's going to affect this 15%, the length of the credit history. So when you close an account, that average age of open accounts is adversely impacted. If, let's say, the account's only been open for 6 months or a year, you're not going to see as much of a drastic decline in the credit score. It's going to be pretty minimal. Now, alternatively, if you have somebody that has a short length in their credit history, you may have them be added as an authorized user to a spouse or family member's account, because now all of a sudden their average age is increased. And that brings us to recommending an authorized user for those that have limited credit profiles or really, really short average age. If they just opened a whole bunch of new accounts and it's skewing things shorter, or they're just overall have maybe one or two accounts in their credit report, they're very new to having or establishing credit, you can impact this category pretty favorably. We have another question on this time on the new credit section, which covers opening new accounts and then inquiries. The question is, how do we best answer when inquiries will start to fall off their credit report? So inquiries are going to show on a client's credit report for 2 years. They're only going to impact the credit score for 1 year. And you are allowed to have 2 inquiries per bureau before it actually starts to impact the credit score. Now, something to consider is if your client has a very limited credit history, they don't have a lot of accounts on their report, because there's less data to go off of, those inquiries could be proportionately a little bit more impactful than they would on somebody who has a more robust credit profile with a lot of history. So just something to consider. We'll talk a little bit more about how to combat that a little later on. And let's see. That's it for the questions I have. And again, if you just joined us, you can use the chat to ask questions or just speak up. It can be as interactive as we want it to be. So, okay. So, limited funds. Often what happens for me is I will have loan officers ask, what can we do if my client does not have enough money based on the simulation to pay off credit cards? Are there any options to still improve the score so we can qualify them? So in this scenario, it may not necessarily be a debt to income issue, but more just getting the score high enough for qualifying. So we have a couple different options. You really want to look at what's missing from their credit score profile, right? We want to make sure we're affecting each of these categories positively. So here's where we can start. With credit mix, do they have open and active loans? So to remind you, credit mix is 10% of the credit score. Really, credit mix is looking at what's the client's ability to pay different types of debt effectively or on time, said better. So if your client only has open credit cards, they are missing the credit mix category. They're not really influencing it like they could be, which focuses again on the ability to pay different types of accounts on time. If the client can show positive payment history on something like a loan, they'll see a score improvement. So we don't want to increase debt to income, right? That's not favorable. We don't want our clients just to be taking out debt to improve their credit score. The option that is available now that didn't used to be and is getting more and more popular is what's known as a credit builder account. So it's a savings account that reports on your client's credit like a loan. $25 a month, so it's going to be very limited impact to the debt to income ratio, but it will help out with the credit mix. So if you have a client that is not ready yet, maybe they're planning on buying within the next 3 months, this would be a good option. If your client's ready to buy right here, right now, today, you're not going to have enough time to see much of an impact to the credit score. But that credit builder loan or credit builder account would be a good option. There are providers, local banks, credit unions, or more popularly, Self. If you've heard of Self or you've seen some of their advertisements, they are a good resource for a credit builder product. Okay. Credit age. Is the credit age too short? Look at, again, the average age of open accounts in the report. If it's too short, an authorized user credit card from spouse or family member is the best option to create credit age, and it really is the only option, other than a couple of other things. We know that not everybody has the ability to become an authorized user, so you can do things like get rent on the credit report. Now we're using this again to create age. So 2 years of your prior rental payment history can be added on a report without having to involve a landlord. So it's simply a connection between the client's bank account and then the provider that essentially attaches it on the credit report. We use a provider called Boom. I can get you guys all these links too, or they're on our website. But the nice thing about that is the lack of involvement from the landlord. The only exception to being able to do this is if that client is paying rent in cash or using a money order cashier's check. We're not going to be able to connect it. But in as little as 2 weeks, you can see 2 years of history added onto the credit report. So that can be pretty influential to creating credit age, especially for those clients that have that limited history or just don't have the funds to pay down debt. Okay, so let's move on to the next one. New accounts. So they have many recent inquiries, and I think this is what Justin was asking about in the chat. So the only real solution is waiting for the accounts to age if they have a new account, or again, authorized user. You can work to remove the inquiries, but inquiries have a pretty limited impact on the credit file. So usually there's some better options. The only time you're going to see inquiries have that massive impact is somebody with new credit history, or that person that's at, let's say, 780 but wants to be at 800. There's limited information that's really pulling their scores down. Okay, so this is the longer one, payment history. What percentage of their payment history is on time? If there is any missed payment history on the credit report, even if it's just a 30-day late mark, this could have a pretty huge impact on the credit score. This is especially true for the FICO algorithm, right? In mortgage lending, because that's that older version. It's not time weighted. So the 30-day late mark for 2017, as I mentioned earlier, is having a big impact on the credit score. And this can be why they pull their FICO 8 score, it's at 700. And then you pull their score, and it doesn't match what they have on Experian, right? It's 680 or 660. So if it's removed, you'll see a sizable jump in the credit score. A person with the perfect payment history with one blemish, the one late mark, it's proportionally worth a lot more than somebody who has a lower credit score but gets a new late mark. And it's because the credit score algorithm is looking at it as an abnormal behavior. It's a risk of financial hardship, right? So think about what the algorithm is meant to do. It's meant to assess risk. It's meant to determine what's the likelihood that someone's going to go past due or can satisfy having a new lending obligation, having a new loan. So since the algorithm is meant to predict that risk, someone with good payment history and a sudden new late mark poses a higher risk because of that abnormal behavior. And the algorithm wants to figure out, are they going through a financial hardship, or is this just a blip on the radar? And the old, unfortunately, FICO 2 algorithm isn't as sophisticated as the new algorithm. So late mark equals hardship. So if you have the scenario where they really just have 1 or 2 late marks and the score is just not where you want it to be, maybe you need a score in the mid 700s, the best solution is credit repair in that scenario. If you've tried everything else to affect the algorithm and it's just not enough, you're going to be in that point where the only option is to get rid of late marks. So your client can either call that creditor, see if they'll do a one-time late mark removal. There are several creditors who will, if they've only had 1 late mark, they will agree to remove it from the credit report. When you are advising your client about that, it's very important to know that that customer service agent that is on the phone talking to your customer does not have the power to remove that late mark. What you want to advise them to do is request that they submit a research request, or it's called different things in different organizations, but typically research request to their credit disputes team for a one-time removal, specifically because they're trying to buy a house. The credit disputes team exists in every creditor. They are not a customer-facing part of the business. So they don't talk on the phone to clients, with the exception of if a request is submitted, sometimes they'll call the client subsequent from the request. But your client is never going to be able to get them on the phone. So That's one way I guess, get a hold of that department. The other way is to have your client write a letter and address it to the credit disputes team. They can do a Google search to find out that proper mailing address, but obviously it can be much faster to get a resolution if they call and request that customer service agent submit a request. If customer service doesn't know what they're talking about, ask for the supervisor. Have them, of course, be nice, not angry. You know, what is that saying? You get more with honey. That's not how it goes, but you get my point. So that can be an effective way. Now, if your client has multiple late marks on that account, that may not be the best option. If this late mark is brand new, it just happened within the last 30 days, absolutely have them call right away. Always have them say they're trying to get a mortgage and this is what's preventing them from getting a mortgage. Even if they're still qualified, just tell them to say this is what's preventing me from getting a mortgage. They will have a lot of success with that. And if they don't, then they can work with someone in credit repair like us. But I think that can save you a lot of grief with recent late marks. Okay. Let's see. I went off on a tangent, so let's see where we left off. Okay. Limited credit history. Too few accounts on the report. We talked about this. Infuse the credit report with credit building tools. Add rental payment history. Add utility bills. Add credit building accounts and more. So you may or may not know Experian Boost is not going to help your credit score algorithm for FICO 2, but it is going to create stack up accounts on the credit report. So you're not going to see that 1-for-1 boost like you will on the FICO 8. So if anyone's familiar with Experian Boost, what happens is your client goes to Experian.com, they sign up for Experian Boost, it connects to their bank account, adds utility bills, Netflix, Amazon, etc. And it will tell them your Experian FICO 8 score just increased by 15 points. You are not going to see that same increase on your FICO 2, 4, and 5, right? Your mortgage FICO. So what you can use are other tools that will report. So it's still good for your client to do that overall, but it's not going to help them with the mortgage, right? It'll help them with other types of lending. So what I will do after this meeting is I'm going to send you resources that will work. So there's a resource called Grow Credit. It functions the same way. We'll add it to all 3 bureaus, but will affect the credit score profile. There's an option called Extra, which will put your debit card on your credit report. So all your debit card transactions can be added to your credit report. So again, limited credit history, infuse the credit report with good information without affecting debt to income, right? These are all things you can exclude. Add the rental payment history. The only things you can't really get added on your report are going to be your insurance payments. That's a common question we get from clients. Can I add my auto insurance? No, you can't. No insurance companies will work with doing that. If it's an informal rental agreement, let's say they're living with their parents and they pay them $500 a month, it can still be added to the credit report as long as it's trackable in their bank statements or their bank account, if you will. So, any questions? Pause there for a moment. Okay, no interaction today. Okay.
I have a question for you.
Go for it.
To go back on what you said about getting a derogatory mark in the last like 30 days. So basically they would be to call the creditor and ask to speak with their credit dispute department, or
they're going to ask to put a request in with the credit disputes department to remove the 30-day late mark. And they're going to want to make sure that they when they put in the request that they explain that they're not getting approved for a mortgage because of it.
Gotcha.
That's going to be the important part. They're going to be much more likely to do it. And not every creditor is going to agree, but it is worth the try because we've had a lot agree to doing it, especially since COVID. So kind of a side note, but on the same topic, if your client did have a 30-day late mark during COVID, actually all the way through, all the way until So through May until June 2023. And they had an accommodation. So let's say they had a late fee waived and it brought them current. So the key is they were past due, they were brought current by an accommodation when they made the payment. So late fee waiver, modification, forbearance, deferment, whatever. That late mark needs to be removed from the credit report according to the CARES Act. We typically have to fight the creditors on that, but if your client doesn't want credit repair, know that that exists. That is a thing that does exist, but it must have brought them current. So if they were like 30 days, 30 days, 30 days, 30 days, and then the last 30 days, they got the late mark waived and it brought them current, only that one can be removed under the CARES Act, not that whole string of 30 days, right? So 30, 60, 90, late fee waived, they got brought current, 90 days off, not the 30, 60. So there's some confusion around that. So lots of fun stuff with the CARES Act we can use for clients. Okay, let's move on. Medical collections. So when you hear medical collections, a lot of times when I'm talking with loan officers, they immediately go, oh, we don't need to worry about that. And their ears turn off. Even though you can ignore medical collections from the debt to income ratio and it doesn't necessarily affect them qualifying for the mortgage, it matters for the credit score. So it is very important to understand medical collections and how you can use them to your advantage, which is a weird sentence in and of itself. But a collection account is extremely impactful to the credit score, right? Because it's deemed one of the most derogatory items on a credit report. So a person with no negative history other than a single collection can see a drop in the score upwards of 100 points. And we've seen it in the middle of an application process where all of a sudden a collection's added. Their score went from 800 to 700. The biggest I saw was an 800 down to a 680 on one bureau and a 660 on another bureau. That's massive just from a single collection. So the good news is medical collections are the quick fix option. So you do not have time to refer your client to credit repair. You need this solved now. Medical collections, if they are paid under $500, cannot report to credit anymore. So simple solution, your client has a $1,500 medical collection. They get it under $500. They don't even have to pay the whole thing off. It cannot report to credit, okay? Now, that doesn't mean that that collection company is not going to keep coming after them, anything like that. So we're setting all of that aside. The whole purpose of this recommendation is get you to the loan, like get the funding to occur, right? If it's paid under 500, it cannot report on credit. If the medical collection is paid in full or settled in full, right? They can settle as long as it's deemed satisfied. It cannot report on credit either. So either scenario, under 500 can't report, paid in full or settled cannot report. If your client gets a collection notice in the middle of your transaction and you do not see it on the credit report, the first thing you want to find out is the age of the medical collection. Because if it's less than a year old, it will not show up on the credit report during your transaction. You do not need to worry. So that's important. They must be a year or greater before they can show on the credit report. And they do have to be obviously over the $500 before they can show up. Gary, do you have a question?
I do. So if somebody had a $750 collection and they, paid $300 down to, get it to 450, what in your experience, then the agency decides to come in and assess, fees or interest or penalties or whatever else. Is it based on the principal balance of what they owe based on that 500, or is it the total amount of the potential collection?
It's based on the principal balance, and there's a limit in how much they can assess as well.
Okay.
So it'd be pretty unlikely if you're having them pay it down to 450 for enough to be assessed for it to reappear on the credit report.
So is that
Timing
like 50
wise,
over about a guideline that you would use? I mean, or what do you normally recommend?
I mean, it depends on the state you're in. Where we're at, I would say that's more in Oregon, Washington, you're more than safe to do 50 under.
Okay.
Because it's very limited in how much interest they can assess.
Okay, cool.
And The only risk we run, which is at this point, because of these changes to medical collections, the law changes are recent enough that we don't have, I guess I would say, enough case studies or enough history to know if this will become a problem, is what's called stacking. So let's say a client has 5 outstanding medical bills to multiple doctor's offices or even one doctor's office. If that collection company has all of those accounts, are they stacking it and making it one account internally so it's above $500 in reports? Or are they keeping them all as separate accounts where they're all less than $500 so they don't report? We have no guidelines right now on whether that's allowable or not allowable. We've seen it happen only once so far where they're stacking like that. I'm sure we're going to see more of it. But I guess my long-winded response is to say the risk you run is if there is another collection, perhaps they stack it on top of that once you drop it down to the 450 to make it higher. We don't know if that'll be an issue or not, but it's possible, and they do all sorts of shady things. So I wouldn't put it past them. But yeah. Ultimately, my warning on any collections is I don't ever recommend having a client pay any of them, but sometimes we got to get the loan funded, right? We need to get it done. And if you do, this is a quick fix, right? And then you can circle back with credit repair on other things later, other collection accounts, or if you only paid it under 500 to get rid of the account as a whole, credit repair can deal with that unless your client just doesn't care, they want to pay it, right? It's all up to what that client wants. So,
Thank you. That's very helpful.
any other questions on medical collections? No? Oh my goodness, everyone's very quiet today. Okay. So, let's move on. Debt consolidation. Okay. I am bringing this up because what we're seeing more of now is a whole bunch of consumer debt. So stick with me on this topic. What I am noticing is, one, values of properties are high. Many people's property value have increased since they got their mortgage originally, meaning they have equity and they have a lot of consumer debt. But because of that consumer debt, they don't qualify for a home equity loan or a home equity line of credit. Has anyone come across that scenario where their credit scores are too low? No? Yes? I'm going to say you've probably seen it. So, this is an interim solution to get to the table to qualify. So, if your client can get a horrendous debt consolidation loan, I say horrendous because the rates suck. But here's what happens. We have, went too far. We have a high utilization because we've got a lot of credit cards with high balances. If we move that consumer debt to a fixed loan, all of a sudden, I'm going too far. All of a sudden, that utilization ratio drops. And now their credit score increases because utilization is no longer high. You can do the home equity loan and you pay off that crappy debt consolidation loan. It does not mean your client's not going to have like a 1% fee to get the consolidation loan or a 2% fee. Some of them are built that way. And it does not mean their interest rate or APR isn't going to be 10 or 15%. It's going to suck. Ideally, they're only going to be in that product for a month or two. And it's a transitionary tool so they can get the home equity loan or line of credit. So the way you want to approach it, because not every client is going to qualify for all of their debt in that debt consolidation loan, you want to look at having that debt consolidation pay off the accounts or the credit cards, the revolving debt, if you will, with the lowest credit limit and highest balance. So highest utilization, low on the lowest credit limits, right? So I want to explain this further. A $500 credit card and a $5,000 credit card that are both maxed are both hitting credit the same way. They're both 100% utilization. So if I pay off 5 credit cards that are maxed at $500, my overall utilization is much, much, much better on my credit report. So tackle all of those small ones, take care of as many of the small ones as possible. So we're helping the ratio, right? So utilization is looked at each account individually, and then the overall utilization of all accounts added up, right? But if we can tackle all these little ones, you're going to see a jump in credit score, which will help. And then you're going to do all the other things we advised. Add all the other good information to the report that might be missing. So we're filling in the gaps where they're not affecting the credit score algorithm. If you're doing that, they get the consolidation loan, you get the HELOC, they pay off all the debt. Let's say they have a 15% car loan, they pay that off with the HELOC too, but we don't care about that for the debt consolidation loan because that car loan is not affecting the utilization ratio, right? We can set that aside and deal with that later. Does that make sense? Did everybody follow my logic? Okay. I'm going to take the silence as a yes. I'm great at explaining things. Cool. Okay. We might sit on this one for a little bit, and I hope, don't be shy, please, because I'm zooming through this stuff and we still got like 10 minutes left. Okay. So dealing with negative payment history. So negative payment history is going to be late payments, collections, charge-offs, repossessions, any account that was included in a bankruptcy, even if that bankruptcy was 5 years ago or 6 years ago, those are negative accounts that are still affecting the score. So how in the world can these be removed from a credit report? This is 100% talking about credit repair. This is not something that I would anticipate any of you want to involve yourselves in, because it's a whole other job on top of the job you're already doing. But I want you to understand what is possible when it comes to removing information from a report. And then we'll talk about why that can be helpful to you closing more loans too. So there are many, many issues with credit reporting. It's often not a question of whether the client owed a creditor or was delinquent on an account. It's 100% all about whether the laws and regulations are being followed by creditor, collection company, and credit bureaus. So there is certainly not an issue 100% of the time, right? But often there is some sort of an issue on a credit report. I have yet to see a report where I didn't find something wrong with it, where we can identify a compliance issue. So by using the laws and regulations and working with reputable credit repair that actually understands the laws, because some don't, you can see a really drastic improvement in the scores. So I wanted to give you some examples. Mismatching information on bureau reports. You have a tri-merge report. You don't get to see the differences, right? You will get one trade line for each account. When we look at a credit report, we can see Equifax, Experian, and TransUnion next to each other so we can identify differences. Any mismatching information is a compliance issue because it can be deemed inaccurate, right? Incorrect months marked past due. Client was late in August, but it shows September on the credit report. We have statements showing they were on time in September. All of a sudden, September is now current. We're not going to give them the August statements. We're not going to tell them to September was current, but you should update August to past due. No. Marked past due when they paid on the 30th day, and maybe the bank took 2 days to process the payment. That's an issue. That's not the client's fault that you took 2 days to process the transaction. So that's kind of the top two are kind of the same, or these two back to back, excuse me. Mortgage servicer change. A lot of times we'll see the servicer change occurred. Client made the payment to the old servicer, not the new servicer, and they get marked past due. That is not allowed. That is not allowed under RESPA at all. Lack of proper validation on collection accounts. They don't have the original contract. They don't have statements from the original creditor, etc. This is how we get almost every single collection off the credit report. Like easily 99% of collections are removed off reports because when a collection company buys a debt, they're buying a pool of consumer debt all at once. A lot of times it's through an auction, and they're not necessarily asking that creditor to send all of the documents that go with that debt. So if that collection agency cannot access those documents from that original creditor or doesn't have it on file, they have to delete the account. That client no longer owes that debt as well. Because remember, once the third party collection agency owns the debt, that creditor is out of the mix. They're not getting paid. They got paid that little bit when the debt was purchased. Okay. So I'm not a fan of debt collectors. I don't want to support them continuing to be in business. So we try to keep our clients from paying them. What's next? Incorrect and missing balances on charge-offs, repossessions, collections, repossessions. Oh my God, there's so many laws that they have to follow that they don't, especially with document notices. A lot of times we'll see there is like they owed 20,000. Let's say they repossessed it, auctioned it off for 10,000. Kelly Blue Book says it's worth 15, but they tried to charge the client the other 10. Can't do that. They can only charge the client the other 5. Maybe they kept the balance at 20,000 on the credit report and they didn't even update it to 10. I mean, all sorts of issues there. I won't bore you with the details. Medical collections, a big issue is not showing the original creditor, which is essentially going to be the provider. It'll just say medical. It won't say the collection company. That's a massive issue. There are 7 states in the country where debt collectors have to have an NMLS. If they don't, they can't collect on a resident of that state. We get the debt thrown out. That's a nice, easy one. When you see that, it's great. Creditors purging and missing documentations, not sending proper notices. Certain states also have requirements that creditors must have the same documentation, that same validation requirements as collection companies. So you can get a 2-for-1, get rid of it on the collection company and get rid of the original creditor account, excuse me, not amount. Okay, bureau showing mismatching charge-off dates or last payment dates. A lot of times we'll see the charge-off date just doesn't match. Sometimes they update it to a year after the charge-off occurred. That doesn't make any sense, right? So overarching theme, things don't make sense, they can get removed. They're not accurate, they can get removed. So inaccurate, obsolete, incomplete. Those are the 3 words. So if it fits any of those parameters, it can be removed from the credit report. It's 100% by the law. And the consumer rights exist for a reason. So it's up to us to fight for the consumer. All right. Any questions on any of that? I know it's just an abundance of information. Okay. Okay. So this is my plug. So with credit repair, what is possible? So the most important way for any credit repair company, whether you work with us or someone else, to approach helping your clients get a high enough score is removing and rebuilding. I think we saw a lot of why through all of the prior slides that we looked at, right? Payment history is 35% of the score. There's another 65% we have to affect. So if you're only removing negative accounts, you're going to hit a wall at some point. If you're only rebuilding, you're going to hit a wall at some point. So the combination of both is where you're going to see the fastest results and the best results. Most clients that work with us are with us about 6 to 8 months to get to the 700s. If they're in the 4 to 5s, most of them are going to start the lending process far before this. Our ideal scenario, they get the mortgage as soon as they can with you, and then we want to keep working on their credit so it gets as high as possible. So when they want to refinance later, they come back to you. You get 2 transactions out of the deal is the ideal scenario. Or maybe they get a HELOC later. I don't know. All depends on where they're starting. If they're lending, if they're borrowing now, I'm guessing it's a refi later. Where most of the partners that work with us, why they like to work with us is not necessarily for quick results. I don't think you should ever approach credit repair with your client anticipating a super quick result. You may have those one-off scenarios where they're 5, 10, 15, 20 points away and there's a quick hit solution that we can help out with, or they get a sudden Comcast collection, we can get it off in a month. But that's not necessarily going to be the norm, especially if you're starting to see right now a lot of clients in the 4s to low 6s, depending on the issues in the low 6s, right? You're really building your pipeline for later. So loan officers that work with us tend to close about 5 to 10 more loans per year, just depending on how busy they are. Those who are doing the Facebook advertising tend to see a lot more lower qualified people coming from those ads, and they are closing a bit more. But again, you want to remember, this is building your pipeline for later. This is a delayed close, okay? This is like 6 months. You're building your pipeline for later. So we can definitely help with getting those clients to qualify. But whoever you work with on credit repair, just know it's a plan for later, not a plan for now. And everything we went through in these slides, this is your now. This is your quick fixes. This is what you can do to get people to the closing table now. And then when they are lower, you know, they got a ways to go or high debt to income. That's building your pipeline. Okay. And this is a little bit about what we've done. I meant to update this morning, but I didn't. So, this year we've saved, I mean, this isn't through September, but hey, it's what, August 3rd. So I'm not that quick to updating this. We've saved our clients $803,000 in removing collections, repossessions, charge-offs. So those are all things clients would have been told to pay. So it can be very powerful to work with somebody who does know what they're doing in the credit repair space, because that's $803,000 clients were able to bring to the closing table that they would have had to pay out of pocket for these debts instead. So it can be extremely impactful to making sure you close more loans, right? So only like 35% of people, and this is old data, but only about 35% of people actually make it to closing from inquiring about a mortgage, not necessarily applying, but coming to a lender and saying, hey, I'm interested in getting a mortgage. Our goal is to help increase those odds. So quick fixes can happen. These are our biggest jumps in 30 days. These are not the norm. These are the rarity, but it's possible. And a lot of this is going to be from the stuff that I taught you throughout this presentation. That's a lot of those quick fixes are from that, with the exception of like getting a repossession removed and it jumps the scores up. Okay. If you want to work with us, you can. We have a partnership portal. You submit your client's contact information. Once you click submit, they get an email and we call them same day. You can track progress within that portal. We're going to send you updates though that are going to have a full analysis every month, says what's changed in the credit report, how scores have improved. If scores went down, we're going to tell you why. We don't hide from that. Sometimes we see the client all of a sudden charged a bunch of money on their credit card. We're going to chase them down, figure out what happened, and make sure we get them back on track. Clients are always going back to you for the lending process. All your contact information's in their client portal with your pretty headshot. So you're always top of mind. And then we're doing the follow-up for you is our goal, to kind of take them off the plate. So we're including you on the communications so you can chime in and be like, oh, great job. That's a lot of progress this month. We're almost there. And then when you refer them, there's a memo section. So you can say, need them at 620. Need to take care of this collection because it's impacting DTI too much, or whatever you need us to know. And then you get a bunch of educational information from us. So it's like bite-sized sections from this webinar, right? More digestible. We send a lot of content you can use with your prospects too. I know one of the more popular ones is 10 ways to get your credit ready for a mortgage. And then we send videos on inquiries, things like that that you can use and send on. Here's my contact info. So screenshot, or I'll email you after this because I'm going to send you the recording. We do have a credit education course. So if you are someone who really wants to learn all the details about credit and you don't want to just attend one webinar at a time, that's for you. But other than that, open Q&A. Any questions, anything we have not covered? I know we're all so eager to talk in today's webinar, but if there is something, I'm more than happy to answer, even if it's a bit off topic.
It's very helpful. Thank you.
Okay.
Yes.
Well, that's good.
I just had something pop up on, I paid off a card and they called me because they assessed me interest. And so I had to go get that all taken care of. So this was very timely and informative.
Yeah, that gets people quite a bit because the interest they put in the next billing cycle from the prior. We see a lot of late marks from that from
I'm
people.
hoping to get it removed.
Yeah. Well,
Okay, the one about doing a debt consolidation loan to then free up the credit utilization, that's definitely an interesting strategy that I will say in all my years I've not employed that one. I mean, I've done some other things to try to pay off debt, but that's an
yeah.
interesting way to go at that I hadn't even thought about.
Yeah, and what works really well is if they bank at a small local bank or a small credit union,
Mhm.
a lot of times they're a lot less restrictive with their lending on the consolidation loans, and they'll work with you more if they know it's going to be paid off with a HELOC or a loan, a home equity
Mhm.
loan too. So I like that.
Very cool. Excited.
Okay. Well, I guess that's it. Oh, wait, did we get a question? Okay, we got one question. Are there plans for agencies to yes. Okay, question is, are there plans for agencies to adjust their scoring model with the credit card utilization monthly, since most people use a lot of credit points when they pay off, however, it doesn't always align with the payment cycle. Okay, so basically what's happening with credit utilization. I'm going to give a brief answer because this was an entire webinar just on this topic last month. So if you want to see that whole webinar, it is on YouTube on the Insight Strategies page. Essentially, the answer is yes. What is happening is they are changing the model that is going to be used in mortgage lending with the transitioning starting Q1 next year. So starting January 2024, long transition. So don't be too worried yet. Going into 2025, April 2025 is currently the date. We'll see how long it takes. Transitioning to FICO 10T. The T stands for trended data. And basically, they're going to look at the average credit card use over a 2-year time frame. So people will be put into 3 different categories: those paying their cards off slowly, those just paying the minimum and the cards staying the same, and those who are increasing their balance over time, with a special exception for those who pay their cards off monthly, which are going to be known as transactors. So people who are paying their balance off slowly are going to see a higher credit score than what they do in their current models, all credit score models, because it's responsible behavior. They're trending downward with their debt. People who are not paying anything off are going to see a lower credit score than the current models. And then people who are increasing their credit usage are going to see a lower credit score than current models. People who pay off their cards each and every month, transactors are now going to be rewarded for it. So they're going to be at higher scores. You're not going to have to worry about timing like you do now. So you're not going to have to have them give you your statement and do a rapid rescore to prove that the balance is 0 now. So that way you see the score boost. That's going to go away with the new model. But what is going to go away is the clients who aren't paying it off every single month. You can't just quickly pay off all the debt, right? And see the scores jump up anymore because it's their average use over the 2 years. If you're following me, make sense? Okay, I'm going to say that's a yes. Next question. Do you pay the debt owed to the original creditor or the collection agency? So once it's sold to a third-party collection agency, that original creditor no longer owns the debt. So you can no longer pay the original creditor. They will not accept the payment. Now, if it was just sold, you may be able to contact the creditor and see if they will take back the debt so you can pay them. Most clients, that's not going to happen. I mean, we've only had twice in the entire time I've been in business where we've been able to do that because most clients are ignoring it. They don't want to face it. So yeah, you got to take care of that right away if you want to do that. So, and then again, don't pay the third party creditor. Go through a validation process first. The exception is what we talked about with medical collections. And then how long can a new credit account be opened after closing the old one? With possible multiple late payments. I'm not sure I'm following that question. How long can a new credit account be opened after closing the old one with multiple late payments? I mean, it won't, if the old account's closed with multiple late payments, the late pays are still affecting the score whether the account's closed or not. Unfortunately, it's like once an account's closed, the positive no longer helps you, but the negative still hurts you. It's really a great system, right? So you would basically have to get those late payments off of the report for them to not affect the score, or get the account off the report. And a new credit account could be opened immediately and you're building new positive payment history, but I mean, it's not going to erase what was done with the old negative. So hopefully that answers your question. I wasn't quite following all the way, but I think that's all the questions we had. Most people have dropped off, so we'll call it a day.
All right. Have a good
And
one.
then I'll invite you guys all to the next one and I'll send the recording. Thanks for coming.
Take care.
Okay.